Hi everyone, hope you all must be doing great. So today we are starting with the mock test paper which has recently been issued by ICI. This is series number 1 and soon they will be releasing series 2. We will be discussing that as well. I'll be discussing taxation income tax law portion with you which carries 50 marks, out of which you understand 15 marks is your MCQs and 35 marks is for descriptive paper. So I'll be discussing this with you today. This is for our September 2024 examinations. I understand now it's just a 1 month left for your examinations. You might be very tensed, very worried. Sir, my this chapter is left, my that chapter is left, and I'm feeling very confused. There is so much of syllabus. How should I cover it? I'm telling you that this is something which is very normal. It happens with each and every student, and you are not no different, right? Instead of overthinking on these things, I would highly request you, recommend you that please stick to your plan, stick to your schedule, just be consistent. See, this 1 month is very much crucial. And here, the main thing which will play a role over here is your patience, your consistency. Just keep on working hard, just keep on studying. I'm telling you that things will be taken care of. So instead of worrying about these things, keep on revising whatever you have done. Please keep on re-revising that, because that would be very much helpful. Second thing is that you should have a fair idea how institute is asking questions from you. So for that, please have a look at the recent past examination paper which has happened in May or before that, and also the MTPs and RTPs. So these are something which is very important. So you will get a good idea of how institute is asking you the question and what type of presentation you should give in your examination, right? So today also I will be discussing this MTP in a very detailed manner, and I tell you that although this video would be quite long, and in fact if it requires, then I'll break this into two parts, and your time is worth investing over here. I'll not be, I would again request you that just not watch this video, but you have to work with me. You have to solve each and every question with me. In fact, in between also, I'll ask you to pause the video and please do the question yourself. And after that, once you are done with the question, you can compare your answer with my answer also, so that you will be able to know what is the difference and how we should present our paper. See, we have a limited time in examination, 3 hours, and we have to use that 3 hours very efficiently. We cannot afford to give more time to any particular question, because all questions are important for us. Each and every mark is important for us, right? So we don't have to make a very big notes or very big working notes. We should be able to solve our paper in that very time efficient manner, so that we can also give to the examiner the presentation which he requires, and also can make him understand that yes, I know the provisions and I have given the answer also. So if you can write a note in just one line and you can explain it, so there is no need to write 4 or 5 lines on that, right? Because again, I'm telling you, each minute would be important for you in examinations. So let's come to this paper now. So I'll be discussing income tax law with you. First, I'll be discussing MCQs. And in MCQ, this is the case study. Second thing is that what should be the approach of dealing with the case studies? See, there are two approaches. First approach is give 1 or 2 minutes, give 1 or 2 minutes and read this case study. Give it a plain reading. After reading, come to your questions. Give a plain reading to your questions and then go back to the case study finally and identify your answers, right? So this is the first approach. Second approach is, before reading this case study, jump directly to the questions. First, read this question, this question, right? After reading this, just give a plain reading. I understand you have not read the case study, so you will not be able to understand 100% of it, but still you will get a good idea what the question is asking from you. So that after that, when you will read your case study, whenever you will be reading, you will be able to identify, yes, on this particular paragraph there was a question, so that you can identify what should be your answer, right? Because in that case, it also happens because in your case studies, 50% of the things are not relevant for us because there is no question asked on that particular thing. So why should waste our particular, we should not waste our time on that, which is not relevant for our questions, right? So my advice to you is approach, kindly follow this approach. First, jump to your questions, read the question, give two or three, it will hardly take a minute or so. Just read these questions first and then come to your case study, right? So let's start with the first case study. I'm also following the second approach. I'm coming directly to the questions. Okay. So the first question says, this is MCQ, and out of four, you have to select the first, the one correct answer. First question says, the amount of tax to be deducted. So we understand that this question is related to TDS, right? So the amount of tax to be deducted by Hamara Paisa Bank on cash withdrawal by Rudra. So there is a person Rudra and he has withdrawn the cash. So we know, do you remember that there is a section, even if you don't remember the section number, but you should know the provision. Although the section number is 194N. It says TDS on cash withdrawal. And do you know the provision? Let me make you revise those provision also. 194N says that whenever you withdraw more than 1 crore rupees from the bank, then that bank will be deducting 2% TDS in excess of 1 crore, in excess of 100 lakh, right? So this is the provision. Also, there is one more point in 194N. See, if you are regularly depositing your return of income, your ROI, if you are a regular filer of your ROI, then we will be applying this provision on you. In excess of 1 crore, 2%. But in case the assessee belongs to non-filer category, non-filer category means if he is not depositing his returns of income on time, then the bank will be deducting TDS 2% after 20 lakh. In excess of 20 lakh, they will be deducting 2% TDS, and in excess of 1 crore, they will be deducting 5%. But that is only for those assessee who are not depositing their return of income on time, right? This is the provision of 194N. So we'll discuss, we will see how much the amount Rudra has withdrawn and whether he is filing his return of income on time or whether he is not filing his return of income on time. Okay. Now come to the second question. Second question says the amount of tax to be deducted. Again, the second question is related to TDS. It says the amount of tax to be deducted by Mr. Rudra on payment made to Tasty Caterer. So here I understand that this question is related to TDS. So Rudra has given some contract to Tasty Caterer. Tasty Caterer is might be some of the contractor. So this person has given a contract to someone. So they are asking how much TDS would be deducting. So we understand that for contract we have few sections. One section is 194C. Do you understand what is the what are the provisions? Do you remember what are the provisions of 194C? Even if you don't remember the section number, but you should know the provision of those where we give contract to someone and we have to deduct TDS. It says 194C says that the rate of TDS would be 1% or 2%. So it depends who the contractor is. If the contractor is individual or HUF, then you will be deducting TDS at a rate of 1%. If the contractor is some other person other than individual HUF, partnership, firm, company, etc., then 2%. So we have a section 194C. Also remember, 194C will come into picture if you have given any contract for your business purpose, for your professional purpose. But if it is for your personal purpose, then we cannot deduct TDS under section 194C. So for personal, if it is for personal nature, 194C will not come into picture. We have another section for that. We have 194M. 194M covers personal contract also. So it says 194M says that who are those people who are not able to deduct TDS under section 194C, then they can come under 194M. But the threshold limit for 194M to deduct TDS is more than 50 lakh rupees. If you are paying in a year more than 50 lakh rupees, then you have to deduct TDS, right? So we have two sections, 194C and 194M. Okay. So we got a rough idea that this question is related to TDS on contract. Let's come to the third question. Third question says, what shall be the amount of what shall be the amount taxable? Amount taxable means taxable income. What shall be the amount taxable and in whose hands with respect to purchase of immovable property by Rudra from SK Builders? Sorry. Here they are asking what is the amount taxable whenever you purchase the immovable property. Now, please tell me that whenever you sell the property, you transfer the property, we have capital gains. But is there any provision in income tax law that whenever you purchase an immovable property, also then you have to pay tax? Is there any provision? The answer is yes. It is in the chapter of IFOS, income from other sources. When you have done the provisions of related to taxability of gifts, there is a provision that whenever you purchase a property of less than the stamp duty value, then it can become your IFOS income, right? So whenever you sell the property, of course it is capital gain. But whenever you purchase a property and if it is lower than your stamp duty value, if you are purchasing, if you are the consideration which you are paying is less than the stamp duty value, then it becomes your IFOS income, correct? But yes, there is a limit also, and if you cross that limit, then only it will become your IFRS income. But if you do not cross that limit, then we simply ignore that, then we will not make it taxable. What is that limit? Do you remember that limit? It is either 50,000 rupees. It is actually higher of the two limits. First is 50,000 rupees, and the second is 10% of the consideration price, right? 10% of the consideration price. You might be remembering, we used to say like this: 110% of the consideration price if the stamp duty value exceeds 110%, right? So actually the difference is 10%. So we have to take higher of the two, 50,000 or 10% of the consideration price, higher of the two, whatever is the highest amount. So we have to take that. If our difference is more than that limit, then it becomes taxable. But if the difference is not more than that limit, then we simply ignore it and we will not make it taxable, right? Okay, so they are asking that point also, and they are asking and gift of the same to his daughter. I think he has given a gift of property to his daughter also, and they are asking that what would be the taxable amount. So we understand that whenever you give a gift to someone who is related to you, that if you receive property from a relative, then it is exempt under IFRS. We don't tax it. Okay, so these are actually three questions which has been asked by the examiner. So now we got a fair idea that what are the three questions on the case study. Now we are reading this case study for the first time, right? Okay, so this case study says, first paragraph says, Rudra is engaged in the business of trading since 2018. So he is doing his business since last 5-6 years. He might be having PGBP income. His turnover, individual, the assessee is individual. His turnover for the previous year 22-23 was 6 crore. His preceding year turnover, right? Our previous year is 23-24. So before that, last year, turnover was 6 crore. Why this amount is given to us? It is given to us because we understand that if the person is individual, then he can only deduct TDS if his turnover of the last year is more than 1 crore rupees, right? So here they have given us information that he is eligible to deduct TDS because his turnover of the last year is more than 1 crore. Okay. Second line says his minor daughter's marriage is fixed in December 23. So his minor daughter is getting married. Minor daughter is getting his minor daughter married. This is something very wrong, but still, let's keep it as a question. So his minor daughter is getting married. He planned destination wedding in Goa, okay, for his minor daughter. For the wedding, he withdrew 40 lakh cash in the month of September 23 and 65 lakh cash in the month of October 23 from Hamara Paisa Bank. So we are getting our first question over here. So the first question was that whenever you withdraw from the bank, then how much the bank would be deducting. So we understand that during this year, he has withdrawn 40 lakh and 65 lakh. The total comes to 105 lakh. which is more than 1 crore rupees. So the bank would be deducting TDS. Now the question is whether he is filing his return of income on time or not. So we'll get that information also. So let's read the entire case study, then we will answer those questions, right? Second point says he booked 30 rooms for 5 days for accommodation of his relatives in Raho hotel and paid 40,000 in cash as advance and balance by account pay check. So this information, I don't think that this is of much relevance because he has booked hotels for guests. Okay, let it be. And there was no question on that also, right? So this point is not so relevant for us. Now he says he took the catering services of Tasty Caterer. Okay, so there was a question regarding that Tasty Caterer, how much TDS we should deduct. So he took the catering services of Tasty Caterer, a sole proprietor. So this Tasty Caterer is a sole proprietor. Okay, for wedding, first of all, 194C will not come into picture. Why? Because he has given a contract to Tasty Caterer, and this is related. This is a personal contract. This is his daughter's marriage function. So it's a personal contract. It is not related to the business. So 194C will not come into picture, right? And for wedding for which he paid 10,20,000 on 15th of October 2023. Right, so he has paid 10,20,000 rupees. See, 194C will not come into picture. 19 we have now another section for contract 194M, right? 194M. But 194M says that whenever you pay more than 50 lakh rupees, so here we are paying just 10,20,000 rupees. So 194M also will not come into picture. Let's see. Now, for her wedding, he gifted his daughter a house property. So he has gifted his daughter a house property. We understand that if so, there was a question on that now, right? So whenever if he has gifted the property to his daughter, there would be no tax implication. Why? Because this his daughter has received the property from her father, right? So there would be no tax implication because that person is a related person. Okay. I'm reading this line again. For her wedding, he gifted his daughter a house property purchased from SK Builders on 10th of October 23. So this person has purchased the property from SK Builders by account pay check for 15 lakh. Okay, so the purchase price is 15 lakh. The stamp duty value of the property, you're getting it? The stamp duty value of the property is 16 lakh. So on this date, when we have purchased, the stamp duty value was 16 lakh. And on the date of transfer to minor daughter, it is 20 lakh rupees. So we will compare on the date of purchase, how much was the stamp duty value? It was 16 lakh. So what is the difference? See, the consideration we have, although we have purchased less than the stamp duty value. So that IFOS provision can come into play over here. But let's see how much is the difference. So the difference is 16 lakh minus 15 lakh. It is just 1 lakh rupees difference. And how much is the allowable difference? Higher of the two amount, 50,000 rupees or 10% of consideration price. How much is the consideration price? 15 lakh. So 10% of 15 lakh comes to 1,50,000, and we have to take higher of the two. That is 50,000 rupees is a fixed amount. 50,000 rupees or 1,50,000, whichever is higher, 150. So if the difference is more than 150, then we will tax it under IFOS. But if the difference is up to 150, we will ignore it. See, the difference is how much? It is just 1 lakh rupees. The difference is just 1 lakh rupees. So we will not make it taxable. There will be no tax implications over here because the difference is not exceeding that limit. Okay. And on the date of transfer of minor daughter, the stamp duty value was 20 lakh. Hardly matters because he's giving a gift to his daughter, and there would be no tax implication in the hands of daughter also. Why? Because here the daughter is receiving gift from her father, related person. Rudra paid 45,000 in cash and balance in check to travel agent for return ticket of some of his relative to US. Hardly matters, not so relevant information. He regularly files his ROI. This is an important information. Why? Because whenever you withdraw the amount from your bank and the bank will be going to deduct TDS, it depends whether you are filing your return on time or not. So here it is mentioned that you are filing your return on time. So bank will be deducting TDS in excess of 1 crore. Okay. Now we are done with the case study. Now let's answer these questions now. So the amount of tax to be deducted by Hamara Paisa Bank on cash withdrawal. So we understand the cash withdrawal was how much? 40 and 65. That is 105 lakh. So here, which provision will apply? In excess of 20 lakh or in excess of 1 crore? In excess of 1 crore, right? In excess of 100 lakh. So in excess of 100 lakh is how much? 5 lakh rupees. So on 5 lakh, 2% TDS will be applicable. This is section number 194N. Even if you don't remember the number, that is fine, but you should know the provision, right? So it says 5 lakh on 2% on 5. So it would be 2% on 5 lakh. How much it is? 10,000 rupees. So 10,000 is the answer is A, right? So we have answered the first question. Second is the amount of tax to be deducted by Rudra on payment made to Tasty Caterer. First of all, 194C will not be applied over here. Why not? It is a personal contract, because 194C covers only contract which is related to your business or profession. It is not related to your business and profession. It's a personal contract. 194C will not come into picture. Okay. 194M. Can 194M can be applied over here? No, because the amount is not more than 50 lakh. It was 10 lakh 20,000 or so, right? So it is not more than 50 lakh. 194M also will not come into picture. So there are only two section which is related to contract. So we will not be levying TDS on it. So what would be the answer? 0. So 10, 20 is not a correct answer. 20, no, nil. The answer will be D, nil. We will not be deducting any TDS. Got it? Now, the last question for this case study. What shall be the amount taxable income, and in whose hands in respect of purchase of immovable property by Mr. Rudra? See, the difference is not more than that specified limit. So what is the specified limit? 50,000 rupees or 10% of the consideration price. And consideration price was how much? 15 lakh. 10% of 15 lakh is 1,50,000. We have to take the higher of the two, that is 1,50,000, and the difference was just 1 lakh. So that will also not come into picture. So there will be no IFRS income. So it will not be taxable in the hands of Rudra. And they are also asking that what was the amount taxable in his daughter's hand. There would be no taxable income. Why? Because his daughter is receiving from her father, that is the related person. So there will be no tax implications. So nothing would be taxable over here. So B answer is correct. Nothing is taxable in the hands of Rudra and minor daughter. There will be no taxable income. So B answer is the correct answer. Correct. So this is our first case study. You got these answers? Okay. Let's come to the second case study. And what should be the approach? We'll straight away read the questions first, and then we will come to the case study. Okay. Let's see the first question. It says, what is the amount of interest allowable as deduction under section 24? Do you understand what is section 24? This is related to house property. So whenever if you have taken a loan on a house property, either for construction or for acquisition, then even for repairs also. So there is section 24B, that what should be the interest which is allowed under section 24B. So they are asking what is the amount of interest allowable as deduction under section 24 to Mr. Mayan for assessment year 24-25. They are asking about the house property interest. Okay. First question is related to 24B. Second question is, what is the amount of deduction permissible to Mr. Mayan under chapter 6A of the Income Tax Act 1961 for assessment year 24-25 if he has opted out of the default tax regime? Okay, so this person has opted out from the default tax regime. We understand if assessee opts for default tax regime, then under chapter 6 there are only few sections which are allowed. If the person opts for default tax regime, do you understand? Do you know, remember those three sections? 80 CCD2, 80 CCH2 related to Agnivir scheme, CCH2, and 80 JJF. These are the only three sections which are allowable if the assessee, an individual assessee, opts for default tax regime, right? But if the assessee has opt out, here the question is saying that this assessee has opt out, he has opted out from the scheme. So he can claim all the deductions from starting from 80C to 80U, right? So this question is regarding chapter 6A, that how much deduction the assessee would be getting under chapter 6A if he has opted out from default tax regime. So here we have to calculate whatever the section which is applicable from 80C to 80U. We will see how much is the deductions available to this particular person. Okay. So the first question is related to section 24B, the interest under house property. Second question is regarding chapter 6A, regarding 80C to 80U, how much the deduction. Let's see the third question also first. In whose hands would Sia's rental income, Sia must be someone, in whose hands Sia's rental income from house property at Haryana be taxable, and how much income would be taxable? So they are asking about some house property income in the hands of Sia. We will see that who this Sia is. Okay. In Sia's hand, in Mr. Myang, Mrs. Myang. I believe that Sia might be a minor child or so. Okay, let it be. Let's now we have a fair idea that there are three questions. First is related to house property 24B interest. Second is related to chapter 6A, and third is there is some house property income, and they are asking in whose hands it would be taxable. Now I'm reading the case study. Getting it? It says Mr. Mayank had bought a residential house worth rupees 2.5 crore at South Extension, Delhi in 2018. So he has purchased a house in 2018, way back, and let out the house property on rent to Rehan. So he has given this property on rent to Mr. Rehan. The property was funded through loan, and he has taken a loan on this property. And there was a question that how much is the loan interest which would be allowable. We will see. The property was funded through a loan from PNB. Okay. The interest due for financial year 23-24 to PNB is 25 lakh, out of which he paid 20 lakh during the year. Okay. So there is a question over we have regarding 24B, and there is something with this information is something which is relevant for us. This, first of all, please understand this concept. See, how much is the interest which is allowed under house property? It depends whether the property is self-occupied or it is let out or deemed let out. See, if that property is self-occupied, we understand the maximum deduction allowable is 2 lakh, although it is 30,000 also in some cases when you have taken it for repair and so, but generally it is 2 lakh. So there is a cap of 2 lakh rupees if it is self-occupied. But if the property is let out or deemed to be let out, in both the cases, there is no such limit for interest. Whatever is the interest, it is allowed. First of all, tell me, you got this point? So first of all, how much is the interest which is allowed? It depends upon the use of the property. If the property is self-occupied throughout the year, maximum 2 lakh. But if it is let out or deemed to be let out, then there is no such limit, right? And here they have given that it is let out to Mr. Rehan. So there would be no such limit. Second important thing is that under house property, whatever is the interest due, it is allowed, or whatever is the interest paid, is that allowed. So under house property, please remember that in house property, whatever is the interest due, it is allowed, whether you have paid it or not paid it. In PGBP, we have section 43B, and so it says that if you have taken a loan from a bank or financial institution and you have not paid it, it will not be allowed. But in house property, it is allowed on due basis, right? So 24B, whatever is the interest which is even due, even if it is not paid, it will be allowed. I believe you got this. So here, the interest due for financial year 23-24 to PNB is 25 lakh, out of which he paid 20 lakh. So he has paid 20 lakh, but this is not important for us. What is relevant? Whatever is the interest due. So 25 lakh is what would be one of my answer. Let's see if there is some other interest also, right? So 25 lakh is relevant for us, 20 lakh is not relevant for us. And this property is let out, so there would be no limit of 2 lakh or so. Whatever is the interest due, it will be allowed. Okay, let's read the other lines also. Mr. Mayank then took a loan of 1.5 crore from SBI. So first loan was from PNB, and now there is another loan of SBI on 1/7/23. Okay, so during our year, he has taken a loan of 1.5 crores for construction of first floor. in that house for self occupation. So his like he is getting his first floor constructed, and for that he has taken a loan of 1.5 crore. The construction is in progress as on 31st March 2024. Very important line. This construction is in progress as on 31st March 2024. See, 31st March 2024 is the end of the previous year. And on this date, this construction is in progress. See, first of all, we understand if the property is not completed, the construction is not completed, then we cannot allow a deduction under section 24B on that loan. Why? Because the property is not yet completed. Sir, this is the first floor, sir. Already he has, and I don't think that there is some other house. He's constructing first floor on this house. So some students might be, there might be some doubt in the mind of some of the students. So that the property was already completed. It was the ground floor which was completed, and he's getting his first floor now getting constructed. So even if it is not completed, the construction of first floor is not completed, even there is a house, so we can allow 24B. The answer is no. See, there is a concept. If there is one house, but if it is used for multiple purpose, let's say first floor we have given it on rent, second floor we are using it for self occupation, it is self occupied, then in that case we consider each unit separately as a separate house. Do you remember this concept? So here his ground floor is let out and first floor is getting constructed for self occupation purpose. For he will be self occupying this particular first floor. So we will treat that as a separate house. And if that is not came into existence up to the end of the previous year, we cannot allow 24B. So on this SBI loan, although he has taken this loan during the year, there might be some interest which would have been due on or after 1st July 2023, but there would be no deduction in this year. Why not? Because the house is not yet completed. So this line is something which is very important. It's a tricky question, so this line is quite important over here. Mr. Mayan started repaying EMI due to SBI. So he has started paying the EMI also to SBI. During the previous year 23-24, he repaid principal amount of 25 lakh and 5 lakh to PNB and SBI. Okay. So during this year, he has paid the principal amount. So how much he has paid? 25 lakh he has paid to PNB and 5 lakh he has paid to SBI respectively. He also paid interest of 8 lakh to SBI out of 10 lakh being interest due. So for SBI, the interest due was 10 lakh, and out of it, he has paid 8 lakh. But this information is not important for me right now. Why not? Because still the house is not yet completed. So we will not be allowing this interest. We will not be allowing this interest, which is for the period from 1st July 2023, from the date which he has taken a loan from SBI till 31st March 2024, end of the year. So this interest would not be allowed. Why not? Because the house is not yet completed. The first floor is not yet completed. Okay. So here only this 25 lakh, this would be allowed under section 24B, 25 lakh interest, this interest, right? So out of which he has paid 20 lakh, not so relevant because in house property, we know that we will allow interest on accrual basis, on due basis, we can allow it. So 25 lakh would be allowed in under section 24B. Second thing is that whenever, if you remember section 80C, right? So in 80C, if you are paying a life insurance premium, if you are paying tuition fees for your children, for the assessee children, or if you are also paying, the assessee is also paying the principal repayment of the loan, then it is also allowed, right? So here they are saying that this person has paid the principal repayment also for the housing loan, correct? And for 80C, the maximum limit is 1,50,000. Do you remember? So this person has paid 25 lakh rupees to PNB. So it is eligible for 80C, but for 80C, we understand the maximum limit is 1,50,000 rupees. So under 80C, because there is a question regarding chapter 6A, that how much reduction he will be getting under chapter 6A. So we have 80C over here. Here, we cannot give 25 lakh reduction because maximum amount which is eligible for 80C is 1,50,000. Okay. So we got few answers over here. Let us read the remaining part of this case study. Second paragraph says that Mr. Mayank owns another house in Haryana. So he has some another house in Haryana. This house was in Delhi. He has another house in Haryana. He transferred that house to his minor daughter, okay, Miss Sia, on her birthday. So he has transferred this house to his minor daughter as a birthday gift, okay. Miss Sia gave the said house to the local panchayat from September 23 at rent for rupees 5,000 per month. The minor daughter has given this on rent at 5,000 rupees. So here clubbing can come over here. Okay. But there is one more point. Let me first complete this paragraph, then I'll tell you. Mrs. Mayank total income for assessment year 24-25 is higher than that of Mr. Mayank. So Mr. Mayank's wife total income was higher this year, and this is the first year when Miss Sia has any source of income. So this is the first year when Sia is the minor daughter. Now, there is two concepts over here. One is of clubbing and second is for deemed donor, section 27. First of all, let's revise those concepts of clubbing. So we understand that whenever there is a income of a minor child, if it is not from the manual labor, it is not from skills or knowledge, right? If the a child is physically handicapped, then clubbing provision doesn't apply. But in other cases, clubbing provisions applies. And whenever the minor child has income and clubbing provisions applies, it will be added in the hands of that parent whose income is higher, right? Whose income is higher, and in subsequent also it will remain same. It will remain same. We will not change unless and until AO feels that it should be changed. So it will be added in the hands of here. It could be added in the hands of Mrs. Mayan, her mother's hand. Why? Because her mother income is higher. If there would be clubbing provision, it will be added. The income will be added in the hands of mother. But I tell you that clubbing provisions will not apply over here. Again, this is the tricky paragraph. Examiner is testing your conceptual knowledge over here. We also know there in house property we have section, the last section we have in house property, that is section 27. This is for deemed ownership, and it says that whenever an assessee transfers their property, whenever an assessee transfers their property to his or her spouse or minor child, except minor married daughter. So here it is not married daughter. Married daughter was in previous case study. So here the daughter is not married. So it says, let me revise that section 27 with you. So it says, section 27 says it has 3 or 4 points. The first point over there is that whenever the assessee transfers their property to his or her spouse without consideration or his or her minor child without consideration, then the transferor will remain the deemed owner, and clubbing provisions will not apply. So here, Mr. Mayank has transferred the property to his minor daughter. Section 27 will apply, and Mayank will remain its deemed owner, and house property income will be taxable in the hands of deemed owner also. So hence, Mayank would be taxable for this property. Clubbing provisions will not apply. Got it? Here, clubbing provisions will not apply. So this information has been given by the examiner to confuse you. Please, and you know that. You are good at conceptual knowledge and you will not be trapped over here, right? So Mr. Mayank would be taxable, the house property income would be taxable, and now understand how much would be taxable. Sir, 5,000 we'll start it from September. So from September, October, November, December, it's 7 months. So 5,000 into 7, 35,000 would be taxable. Is it? 35,000 is a rent received. So we can consider it as a GAV, right? GAV is 35,000. Municipal taxes paid, there is no information. So minus municipal tax is 0. It will be NAV. So NAV is 35,000. And we understand how we calculate the income for house property. From NAV, we have standard deduction 30% of NAV. So subtract 30% from 35,000. Whatever is the amount, how much it would be? I'm doing it over here. 5,000 is the rent for 7 months. It would be 35,000. So it would be GAV, and there is no municipal taxes. So it would be NAV, right? And minus 30% of NAV, that is the standard deduction. So 35,000, 10,500. So 24,500. I am presuming that there is no loan on this particular house. So there is no 24B on this Haryana house. There was a loan, but it was in on Delhi house. It was not on Haryana's house. 24,000 would be the house property income. In whose hand? In Mr. Mayank's hand. Mr. Mayank. Will it be clubbed in the hands, or there would be no clubbing provisions? It would be deemed ownership. Okay. So let us read the last paragraph. Mr. Mayank bought electric vehicle. Okay. There is a section in chapter 6A, 80cc, 80 EEB, which says that if there is electric vehicle, if the assessee has purchased an electric vehicle and he has taken a loan, so whatever is the interest could be allowed, but maximum 1,50,000 rupees. Do you remember that section? So Mr. Mayank bought electric vehicle worth rupees 50 lakh on loan from BSM Bank, which is sanctioned on 1/4/2022. BSM Bank charge interest of 7 lakh rupees on electric vehicle for this year. So the interest is 7 lakh rupees. But we understand in 80, even if you don't remember the section number, but I believe that you remember the concept, it says that maximum, the provision says the maximum interest which is allowed is 1,50,000. So here the interest was 7 lakh on this electric vehicle, but maximum 150 is allowed. Okay. Next, it says Mr. Mayank has also taken a loan from ABC Bank for his daughter's higher education. Okay, for higher education, we understand that there is a section 80E for education loan. Okay, and he paid 50,000 as interest to ABC Bank. So whatever is the interest, it is allowed under 80E education loan. So 50,000 rupees is the interest for education loan. He also paid Mediclaim of 20,000 to New India Assurance Scheme for insuring his. So this person has also paid Mediclaim insurance. So Mediclaim insurance, we have 80D. And how much is allowed? 25,000. If the assessee is a senior citizen, then maximum is 50,000, right? But here the amount which is paid is even not more than 25,000. It is just 20. So we will get 20,000 over here. So we have 80 EEB, 80E, 80D, and we have 80C also, right? You remember that if this person has paid that principal repayment, so 1,50,000 would be 80C. So 150 would be the 80C. So there was a question, how much is the deduction available in the chapter 6A? 150, 153 lakh, 350, 370. So 370 is the answer for that question, where it was asking us what is the deduction in chapter 6A? 370. C is the correct answer for the second one. Okay. Now the first question was that what is the amount of interest allowable under deduction in 24? So we have we have two houses. One is in Haryana. First is in South Extension Delhi. Second was in Haryana. For Haryana there is no loan, but for a Delhi house there was a loan. But we can only allow the loan which was from PNB because SBI interest, the second loan, the house is not yet completed, right? So for PNB the amount due was 25 lakh and it was let out. So entire 25 lakh can be allowed. So 25 lakh is the correct answer. Answer is B over here. Got it? And third question is that rental income would be taxable in the hands of Sia's hand, minor child hands, her mother's hand or her father's hand. It would be in the hands of her father by Mr. Mayan because there would be no clubbing provisions will apply. It will be taxable keeping in mind the provisions of deemed ownership. So we have calculated how much? 24,500 in the hands of Mr. Mayank. So Mayank would be taxable 24,500, right? So the answer is B over here. So this is our second case study. Got it? Okay. Now we have few more MCQs that these are standalone MCQs. So the third MCQ is Mr. Arpan, age 35 years, not a senior citizen, submits the following particulars for the purpose of computing his total income. Okay, so we have to compute his total income. Income from salary computed. What does this word computed means? That we don't have to give any further standard deduction or so. It is already computed, right? All the deductions have already been given. So this is the last salary amount which is taxable. How much? It is 4 lakh rupees. Loss from let out house property is 2,20,000. Okay, so he has house property loss of 2.2 lakh. Brought forward loss from let out house property for assessment year 23-24. So from last assessment year, we have some brought forward losses. How much? 230. And we understand that whenever the house property losses or any head losses are being carried forward to subsequent years, it can only be set off from the same head, right? When we carry forward last year losses, right? So it can be set off from the same head. But in this house property loss can be set off only from house property income, but in the current year itself we have losses, so this loss obviously will not be able to set off this year. We have to carry it forward. Why? Because in the current year house property we have loss again, so this 230 would be anyways would be carried forward, so 2,30,000 would be carried forward. We understand this much. Okay, business loss. Okay, how many losses he has? He has business loss of also 1 lakh rupees. I'll read it once again. He has salary income 4 lakh and got positive. Salaries or anyways will be positive. So salary is positive. House property he has current year house property he has lost. Last year house property also it was lost, but it cannot be carried. It will not be set off this year. Why not? Because here we have no positive income. We have only losses in house property. So it will be anyways will be carried forward. Business loss we have. Okay, we have business loss. And bank FD is 80,000 rupees. So this is IFOS. Okay. First of all, tell me, business losses can be set off from salary? No. Business losses can be set off from any head if it is not speculative loss or if it is not specified business loss. So normal business loss can be set off from any head except salary, and of course from casual income. From casual income, you cannot set off anything. But yes, from salary it cannot be set off. Can it be set off from house property? The answer is yes. Business loss can be set off from house property, but in house property, anyways, we have loss. So house property will not going to help us. Whether business loss can be set off from IFOS? Yes, it can be set off. So 1 lakh can be set off from this 80,000, but still there would be 20,000 rupees which will remain, and we have to carry it forward. Okay. Compute the total income. So here the question is asking us to compute the total income. We have to compute the total income of Arpan for assessment year 24-25 and the amount of loss that can be carried forward. We also have to compute the loss which have to be carried forward for subsequent assessment year under normal provisions. Under normal provisions. Normal provisions are what? When we opt out from default tax regime, right? So it is optional regime, old scheme. We have to follow the optional regime. Why they have given this point over here? Because we understand in default tax regime, I believe that you remember this concept. In default tax regime, we cannot set off the house property loss from other heads, right? In default, if the assessees, please remember this point. Even if you have forgot it, please remember this now. If the assessee is opting for default tax regime, and if there is a house property loss cannot be set off from any other head if the person is following default tax regime. But if the assessee is following optional regime, here it is normal regime, optional scheme, house property loss can be set off from other heads, but maximum 2 lakhs, right? So in optional scheme, we can set it off from other heads also, but maximum 2 lakh can be set off, right? So here, this assessee is not following default regime; he is following normal tax regime. So first of all, we have house property loss. Okay, this house property loss can be set off from salary, yes, but maximum 2 lakh rupees. Okay. So out of this 4 lakh, we will get remaining would be 2 lakh. And out of this 220, 2 lakh was set off from salary. So we still have 20,000 rupees which would be carried forward, right? And house property, this would be anyways would be carried forward. So total house property loss of 2,50,000 would be carried forward, right? This is a loss. And out of this PGBP 1 lakh we have negative, we can set it from 80,000 rupees, but still 20,000 rupees PGBP income will be, sorry, PGBP loss will be carried forward, right? So we have income only from salary, which is left now, it is 2 lakh rupees. These are all losses. So 2 lakh is the income and 250 is the loss for house property which will be carried forward. To 20,000 would be the PGBP loss which will be carried forward. So the answer would be, first option says total income of 2 lakh. Okay, correct. And loss from house property 250. Okay, correct. And the business loss of 20,000 to be carried forward to subsequent years. Correct. This is seems to be correct answer. Let's see. Let's check the other options also. Total income of 160. No, it is not correct. Total income of 4 lakh. No. Total income nil. Obviously no. First answer is correct. Right? You got that? The first answer is correct. Okay. Last MCQ. It says Mr. Raja, age 64 years, senior citizen, was not able to provide satisfactory explanation to the assessing officer for the investment of 7 lakh. Okay, they are asking about the unexplained investments. So this person has an unexplained investment of 7 lakh rupees, which was not recorded in the books of accounts. What shall be the tax payable by him on the value of such investment considered to be deemed income as per section 69? 69 we understand this is related to your unexplained investments and all. So what is the tax on that? We have the tax rate of 60% plus surcharge of 25% plus 4% cess. So we understand on these unexplained income, we have tax rate of 60%, and on it, we have fixed surcharge of 25%. 25% on 60, right? First of all, you have to calculate tax, and on that tax, you have to calculate 25% surcharge, and on that amount, you have to calculate cess at a rate of 4%. So effectively, it becomes 78%. I believe that you remember this percentage, 78%. See, 25% on 60. 25% on 60, it will become 75. On 75, 4%. So it will become 78% effective tax rate. So on 7 lakh, apply 78% effective tax rate. So 7 lakh into 78%, it's 5 lakh 46,000. So C is the correct answer. C is the correct answer. Got it? So these are our MCQs. Now come to our descriptive questions. Now let's start with our descriptive part. Question number 1. And you understand question number 1 is a compulsory question, which carries 15 marks. And out of the remaining questions, we have to attempt only 2. So first question is compulsory. And out of the remaining second, third, and fourth, we have to opt for any 2 questions. One is in choice. Okay. Okay. One more important thing. See, this total income question, which is of 15 marks, it is the most time consuming question. It is generally seen that it is the most time consuming question. So my recommendation to you is that please attempt this question at last. First of all, you should be, you have to maintain your speed from the very starting. First thing. Second thing is that because this question is generally time consuming, my recommendation to you is please do not attempt this question first. First, do your these remaining questions. Out of these 3, you have to attempt 2 questions. First, complete those questions first, and then come to this particular question, right? So otherwise, if you will be attempting this question at the first place, then it is high chances that you will it will consume a lot of time. So my recommendation to you is please do not attempt this question at first time. At first finish these 2 questions, then come to this question, right? But right now, as of now, I'm just explaining to you. So now, as of now, I'm attempting this question first, right? But in examinations, please attempt those 2 questions first and then come to this question. Okay. Question number 1. It says, Ayush is a resident individual, age 54 years, not a senior citizen, is engaged in the business of manufacturing. This is important for us. Why manufacturing? Because if this person is following optional tax regime, he's opting out from default tax regime. So if a assessee is involved in manufacturing operations, and in case this person has purchased any new plant and machinery which is installed in factory, then this person is eligible for additional depreciation. So additional depreciation is available only to person. First thing, this person, if this person is following default tax regime, then there is no concept of additional depreciation. It is only in optional tax regime. That too, if the person is engaged in manufacturing operations. So here it says that this person is having manufacturing business. Okay. So we'll see that whether he will be following default tax regime or he would be opting out from default tax regime. Then we will be giving additional depreciation accordingly, if there would be any. He earned profit of 82 lakh 45,000 as per his PNL account. So as per his PNL account, he has 82.45 lakh of profits after debiting and crediting the following items. How many items are given? 4 items. So these items are already there in the P&L account. So it says after debiting or crediting, it means that these items are already there in P&L account. What was the depreciation was there? Okay. If they will give any other information regarding depreciation, let's say if they generally give this information that this depreciation is as per books, as per income tax, we have some other depreciation, then we have to take that depreciation. Then we will going to disallow it. But if the question is silent about this depreciation, then we always assume that this depreciation is as per income tax act. Let us see what type of depreciation it would be, right? So depreciation is already debited. Okay. Second point says that short-term capital gain on transfer of listed equity shares in a company on which STT is paid. You remember there is a section 111A on such STCG, the equity shares which you sell on stock exchanges, there is a special rate of tax 15%. How much is the amount? 10 lakh rupees. So 10 lakh rupees is the short-term capital gain. But the point over here is that this person has credited this amount in his P&L account. So we understand that if this person in his P&L account, this person has shown this short-term capital gain, we understand that this is not PGBP, this is capital gain. So we have to take it out from PGBP. So while computing your PGBP, you have to take it out from PGBP and you have to take it to capital gain head, right? So this is other head income, which is wrongly credited to P&L account. We will take care of it. Third point says he received income tax refund of 15,550. So this person has also credited 15,550 as an income tax refund. Income tax refund is what type of income? Is it PGBP? No, it is not PGBP. So we have to take it out. Is it IFOS? The answer is no. Income tax refund is neither expense. Whenever you pay income tax is not a deductible expense. And whenever you get an income tax refund, it is not a income also. So income tax refund is not an income. It is not a taxable income. But this person has credited this amount, right? So income tax refund is not your income. Please don't please don't bring this income tax refund under any of these heads, right? So it is not taxable. But yes, remember, if it is interest on income tax refund, then it becomes income of IFRS, right? So let us read it full. He said, the question says, he received income tax refund of rupees 15,550, which includes interest on refund of 545,550. Interest on income tax refund is IFRS, right? So out of this 15,550, only this amount should be taxable under IFRS. Remaining should not be taxable under any head. Fourth point says, dividend income from Indian companies is 15 lakh rupees. We understand that dividend is your IFOS income. So this person has, see, all these 4 points were already there in P&L account. So this person has wrongly credited this dividend amount in his P&L account. We have to take it out from PGBP. 15 lakh is not PGBP income. We have to take it out and we have to take it to the IFOS head, right? It is 15 lakh rupees should be the dividend income, which should be taxable under IFOS. Okay. Second line says dividend received from each company is less than 5,000. Why they have given this particular information? See, 15 lakh is the total dividend. This assessee, Ayush, must have invested in so many companies' shares, right? The total dividend which he has received from all the companies is 15 lakh. We understand that 15 lakh is IFOS dividend income. But from each company, the amount is received is not more than 5,000. Why they have given this information? It is because we understand there is a TDS provisions on dividends that whenever the threshold limit is more than 5,000, so the company used to deduct TDS on dividend. So there would be no TDS also. So this information is just to tell you that no TDS was deducted on this dividend, because from each and every company, from these so many companies, the dividend which we have received from each company was not more than 5,000. So there, none of the company has deducted any of the TDS. The total amount which we have received is 15 lakh. That is okay. But from each company, the amount was not more than 5,000. So no TDS was deducted. I think you got this point, right? Okay. Now we have additional information. The additional information says Ayush installed a new plant and machinery, okay, for 65 lakh on 1/10/2023. So this person has installed a plant and machinery on 1/10/2023, which was put to use on 1/1/2024. This is important. He has purchased a machine this year, but it was put to use from 1st January 24. January 24, February, and March, only 3 months, less than 180 days. So we will be charging depreciation at full amount or half, right? For half of the year. Generally, the depreciation rate on machine is 15%, 15%, but this machine is installed for less than 180 days, purchased this year and installed for and used for less than 180 days. So we will be computing half of 15%, that is 7.5%. Depreciation including additional depreciation. Additional depreciation will also be there. Why? It's a new plant machinery. So I believe this person is opting out from default tax regime. Let us see. You are required to compute the total income and tax payable by Ayush. Okay, we have to compute the total income and tax payable, assuming that he has shifted out of the default tax regime under 115 BSA. So he has opted out from 115 BSA. So he is following optional tax regime, not default tax regime. Okay. So additional depreciation would be there. Depreciation, including additional depreciation on this amount of 65 lakh, is included in the depreciation debited to P&L account, which has been computed as per income tax rules 1962. What does it mean? They are saying that you are not required to compute depreciation. Why? Because it has already been included. It has already been included, so you don't have to compute depreciation or additional depreciation. So on 65 lakh, we have already taken the depreciation as per income tax rules. Already it is debited under this depreciation amount. So I believe this depreciation as per income tax act. So we don't have to do anything out of it. So first information is just for our knowledge purpose. We don't have to do any calculations over here because it has already been taken. It has already, the depreciation normal as well as additional depreciation has already been calculated and it's already been included as per income tax rules. So this information they have just given to us, but we don't have to do any calculations out of this first point, right? Second point, it says Ayush took a loan from SBI of rupees 50 lakh. Okay, so this person has taken a loan. Assessee has taken a loan of 50 lakh rupees on 1/9/2023. Okay, on 1st September 2023, he has taken a loan at a rate of 10.5%. Okay, to purchase such plant and machinery. Okay, this plant and machinery of 65 lakh, he has taken a loan of 50 lakh rupees. Total interest up to 31st March 2024 has been paid on 31st March 2024. So this year interest we have already paid. Okay, good. And the same has been debited to the P&L account. See, very, very important point over here. Ayush has taken a loan on this asset, correct? And whatever is the interest that has paid for the year, and he has debited that interest in his P&L account. First of all, tell me whether you can take loan for your business purpose for purchasing your asset. The answer is yes. It should be allowed also. The answer is yes. Under section 36(1), we understand. Section 36 says that if you take a loan for a business purpose for purchasing your asset, it is allowed. It will be treated as a revenue expenses. However, there is one important point. If you take a loan, if assessee takes a loan and for purchasing an asset, for acquiring an asset, and if the asset up to the date the asset is put to use, that interest up to the date the asset is put to use, up till that date the interest should not be treated as a revenue expenses. it should be capitalized. It should be added in the value of the asset, right? On which you can claim depreciation. You have to claim depreciation. It will not be allowed as a revenue expense. Once the asset is put to use, you can allow it as a revenue expense. I believe you remember this point. Okay. So this person, what this point is mentioning to us, it says that the entire interest has been debited to penal account. So he has taken a loan from 1st September and the asset is put to use on 1st of January. So September, October, November, and December. 4 months interest should be capitalized. It should not be debited. It should be capitalized. So this person has debited this interest. So we'll say, no, you have done it wrong. We have to add it back. We have to add it back. It is not a revenue expenses. It should be a capital expenditure, which should be added to your machinery amount, and you can claim depreciation. So first of all, you have to compute this 4 months interest, how much it is, and you have to disallow it. So for 50 lakh, 50 lakh is the loan amount, 10.5% is the rate of interest, and calculated for 4 months. How much it would be? 50 lakh into 10.5% divided by 12 into 4. I believe it is 1,75,000. So this is the extra interest which is debited. So you have to add it back. Please disallow it. Got it? Because this should be capitalized. First point, you have to add it back. Second thing is that now it should be capitalized. Now you have to give depreciation on it, right? Please give depreciation on this amount. So, and also because this person is opting out from the default tax regime, this person is a manufacturing assessee. So you have to give additional depreciation also. So you have to calculate both normal as well as additional depreciation on this amount, right? Because this person has not taken this amount into consideration while computing depreciation. He has debited, he has claimed it entirely as revenue expenses. But we know that 4 months up till the date when this machine is put to use, we have to capitalize it. So now you have to compute the normal depreciation on this amount, 1,75,000 into 15% into half. Why half? Because this asset is put to use for less than 180 days. Acquired during the year, used for 1 lakh, less than 180 days. So how much would be 15%? 13,125 is the normal depreciation, and additional depreciation also you have to give. How much is the additional depreciation? Generally, it is 20%. But if the asset is put to use for less than 180 days, it will be 10% this year and the remaining 10% next year. So 10% we will be giving this year. 10% on 175,000. You understand 175,000? It would be 17,500. So this is the depreciation. This is the extra depreciation which we will be debiting, right? This is the, he has wrongly treated it as a revenue expense. So we will add it back and we will capitalize it. And now we are capitalizing it. Since we are capitalizing it, we have to give the effect of depreciation. So this is the depreciation effect which we will be giving it. So this would be added back and this would be subtracted while computing your PGBP income. Got this point? Important point. Okay, third point says advance tax paid during the year is 17,50,000. This is the advance tax which you have paid because we have to compute the tax payable also. So first we'll be computing the total income, then the tax liability. So whatever is the tax liability, we will be deducting any TDS, TCS or advance tax. So this is the advance tax that will be, we will be taking the 17.5 at the end once we compute the tax liability. Ayush purchased goods of rupees 40 lakh from Ram, his brother. The market value of the goods is 35 lakh. We understand that it's a related party transaction. So if you have paid in excess of fair market value, the extra amount would be disallowed. So here the fair market value was 35 lakh and you have paid 40 lakh rupees as a business expense. So 5 lakh rupees which you have paid extra, it would be disallowed, right? It's a related party transaction. If you remember the section number, you can quote the section number also. The section is 48.2. If you don't remember the section number, it's okay. You just write it down that he has made the payment to the brother in excess of fair market value. Correct? Fifth point. He paid 40,000 as a life insurance premium taken on the life of his married daughter. Okay, life insurance premium. This person is following not following default tax regime. So 80C can be allowed. So life insurance premium, we understand 80C. In 80C, assessee can pay the premium for himself or herself, or for the spouse, or for children. Whether those children are dependent children or not, 80C is allowed over there. For life insurance, it is allowed. 80C life insurance, 80D health insurance. In 80D, the children must be dependent. For health insurance, in that provision 80D, the children must be dependent. Spouse can be dependent, non-dependent, but the children must be dependent in 80D. You understand? You can remember by this way, D for dependent, right? So for 80D, the children must be dependent. But for 80C, the children can be dependent or non-dependent. You can pay life insurance premium for them. So he has paid 40,000 as life insurance premium taken on the life of his married daughter who is not dependent on him. Still, he can claim 80C. Maximum amount of 80C is 1.5 lakh. He is paying 40,000 over here. So 40,000 could be allowed over here. And the sum assured is 5 lakh, and the policy was taken on 1/4/2016. You understand? Up to the maximum amount of 10% of sum assured. So 5 lakh into 10% is 50,000 rupees. So we are paying less than that. 40,000 would be allowed under 80C, right? He has paid 45,000 by check towards health insurance policy covering himself, spouse, and children. So if he has paid for himself, spouse, and children, we understand that for senior citizen, he was a senior citizen. No, he was not. So maximum 25,000 would be allowed. 45,000 would not be allowed. Maximum 25,000. If he would have been senior citizen, then we would have allowed 45,000 rupees. But here he is not a senior citizen, so 25,000 would be allowed. Okay. On 1/7/23, Ayush withdraw 1.5 crore in cash from 3 current accounts maintained by him with SBI. There are no other withdrawals during the year. He regularly files his return of income. Same thing. This person has withdrawn from SBI. So although they are from different accounts, but the bank was one, just SBI. So, and he's filing his return of income on time. So a 1 crore provision would be applicable. So SBI must have deducted TDS in excess of 1 crore. He has withdrawn how much? 0.5 crores. That is 50 lakh. So SBI had deducted TDS of how much? 2% on 50 lakh. How much it would be? 1 lakh rupees. So 1 lakh rupees is the TDS. Because this question is asking about the tax payable. So first you have to compute the tax liability, and from tax liability you have to deduct TDS. So this is the amount of TDS. 1 lakh rupees is already deducted for cash withdrawal. And if you remember the section number, you can mention it. If you don't remember, it's okay. 194N. And he has also paid advance tax of 17.5 lakh. So please take the credit, and after that you have to pay the tax, whatever is the tax payable. Okay, now you are required to compute the total income and the tax payable. Okay, now since we have discussed this question, now I would request you to pause the video and please attempt this question. Whatever you know about this question, whatever we have discussed based on that knowledge, please try to present this question, right? I am also doing this question, and later on you can compare your answer with my answer, right? So let's start with the question. You can pause the video here and let's start doing this question first. Okay. So I believe that you are done with the question. You must have seen also. So this is how we're going to present it. You have to write the answer, the number, very cleanly and very diligently. You have to write this number so that examiner can know that you have answered this question. And please always start a fresh question on a very fresh page. Any new question, please start on a fresh page, right? So this is the answer one, the number I have already mentioned, computation of total income in the tax payable. And here I have calculated PGBP, right? So this is our PGBP income, then capital gain income, IFOS. We have two IFOS, one is dividend and other is interest on income tax refund. 15 lakh 4,550 is the IFOS. We calculated gross total income. We have PGBP, capital gain, IFOS. Then we have given the deductions ATC and ATD. This is the total income. We have rounded it off. Even I have although mentioned the section. If you don't remember the section number, it's okay. You can just mention rounded off, right? And then we have to calculate the tax. There is one special income of 111A. So on that 10 lakh rupees, we have calculated 15% tax, 1,50,000 rupees. And on the remaining income, it was normal income. So we have applied the normal slab rates of 2.5 lakh, 2.55 and so on, because the assessee is not following default tax regime. So the tax comes to 23 lakh 6,514. And since the income is more than 50 lakh, it is not more than 1 crore, but it is more than 50 lakh. So there will be surcharge also of 10%. Apply surcharge on this amount and on total apply cess. So this is the tax liability. 26 lakh 38,652 is the tax liability. But we have to compute the tax payable, right? So this is the tax liability, and from tax liability, please take the credit of any TDS or TCS which has already been paid or collected, and also the advance tax which you have paid. So out of this tax liability, we have already paid advance tax of 17.5 lakh. Already TDS has been deducted. So the remaining amount comes to 7,88,652. So this is the ultimate tax payable, right? So this is now the liability which you have to pay to the income tax department. And of course, it should be rounded it off to the nearest 10. 788,650. If you remember the section number, it is 288B. Otherwise, you can forget it. Just write it, round it off. Okay. So this is 788,650. Now I'm splitting this video into two parts. So this is part one. Let's keep it part one, and I'll be continuing it in part two, where we'll be discussing the remaining questions of this MTPs. So let's meet with the in the second portion. Till then, thank you so much. Bye bye and take care.